When we hear about investing in leading innovative companies like Google, Facebook, Amazon, Tesla, etc., we tend to focus on their gigantic size and high returns that they have generated for their shareholders. But even with these innovative giants, there were periods when they had fallen more than 50% several times when they were young. Even Nasdaq 100, which is generally regarded as a proxy to large innovative companies, today has just 40% of the companies from the last decade. This means 6 out of every 10 companies that were part of Nasdaq in the last decade are no longer part of it. Essentially, this tells you innovation, disruption are frankly all risky spaces to invest in. DSP Global Innovation Fund of Fund gives you access to a mix of well-established companies as well as many young, early-stage disruptors. Ups and downs in smaller companies are inevitable, indicating that some may fail in years to come or can witness sudden and significant fall in stock prices. This is also likely to result in DSP Global Innovation Fund of Fund having higher volatility and periodic drawdowns. To give you a perspective, our basket of innovation-oriented funds has also periodically witnessed a fall in stock prices by more than 20%, indicating a higher risk. These drawdowns percent, when compared to what you'd get if you invested in Nifty 50 companies in India, are high. This is why we recommend that investors come into DSP Global Innovation Fund of Fund via the long-term SIPs. This will enable investors to accumulate higher units whenever the fund's NAV goes down. And then the higher units can help to generate better returns whenever these innovative companies start performing. A long-term horizon, let's say about 7 to 10 years, can help investors to get a smoother investment experience with a higher prospect of generating better return. Based on a blended NAV series of multiple innovation-oriented funds since 2002, it has been observed that the SIP route has generated far better returns than the lump sum. Even considering consistency of SIPs over lump sum using 10-year average rolling returns, the SIP route beats lump sum handsomely. The minimum return over any 10-year period is far better via the SIP route versus the lump sum phase. This data suggests that a SIP in DSP Global Innovation Fund can not only enable Indian investors to diversify their SIPs globally, but can also allow them the chance to get a smoother investment experience in this frankly risky space. What's more, this also gives you a potential to earn higher returns compared to SIP in Indian equity, say in Nifty 50. This is why we recommend investing in DSP Global Innovation Fund of Fund via the SIP route.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.